Welcome to the Deep Dive, where we take complex information, peel back the layers, and really try to uncover the most important nuggets of knowledge and insight. Sometimes, the most profound revelations aren't in the flashy headlines, but they're kind of hidden within what might seem like, well, the driest documents.
Exactly. And today we've got a really intriguing pairing for our deep dive. On one hand, we're drawing from a list. It's titled 60 Engaging Podcast and YouTube Interview Questions, covers all sorts, personal growth, finance, you name it. And on the other, we're delving into a very detailed letter to shareholders. This one's from Wesco Financial Corporation, penned by the, legendary chairman Charles T. Munger, specifically covering their 2002 performance.
Right. And our mission today for you is to show how a seemingly, dense financial report like this can actually illuminate answers to some of those deep, insightful questions we might ask anyone in an interview. We're going to explore real-world examples of business resilience, delve into a pretty unique financial philosophy, and examine the challenges of leadership, all extracted from, a very specific moment in time. Okay, so let's start right at the top. Wesco's consolidated net income for calendar year 2002. The letter reports $52,718,000, or $7.40 per share. Now that was, and they quote, essentially the same as the $52,536,000, or $7.38 per share from the year before. So on the surface, that looks incredibly stable. Almost boring, right?
It absolutely does look stable. But what's truly fascinating here, and this is key, is that the reported numbers, they don't tell the whole story. And that's because of a pretty significant accounting change. See, in 2002, Wesco stopped amortizing goodwill. That was a new requirement from the Financial Accounting Standards Board, FASB. Now, here's the interesting part. If we adjusted the 2001 numbers to look like they were calculated under this new 2002 rule, what's called a pro forma adjustment for a direct comparison.
Okay, apples to apples.
Exactly. Then 2001's after-tax income would have been much higher. We're talking $59,350,000 or $8.34 per share. So what this means is, on that like-for-like basis, Wesco's 2002 after-tax net income actually decreased. Yeah, decreased by over $6.6 million or nearly $1 per share compared to 2001.
Wow, that's a huge shift in perception, isn't it? It really underscores how easily numbers can be, misinterpreted if you dig into the footnotes, the details. So, okay, knowing that, how did Wesco's underlying businesses actually fare? Munger's letter goes deep into their four major subsidiaries. Let's look at their insurance businesses first. Wesco Financial Insurance Company, or WesFEI, and the Kansas Bankers Surety Company. Now, together, they showed improved operating earnings in 2002, reached nearly $50 million, up from about $45 million in 2001. But what was behind that seemingly positive turnaround, given what you just said about the overall income?
Right, good question. Well, the 2001 results for the insurance arm were actually described in the letter as the worst since we entered the insurance business in 1985, so pretty bad. While 2002 was merely satisfactory, the critical factor here, the big shadow, was the devastating events of September 11th. That delivered the insurance industry its largest loss in history, period. WesIC recorded an estimated $10 million pre-tax loss directly from that event. Munger explicitly states that was the principal cause of their substantial underwriting loss back in 2001. They were prepared for natural catastrophes, hurricanes, earthquakes, but this was, as Munger put it, a different kind of beast entirely.
That's incredible context. And it really offers a vivid lesson, doesn't it, for anyone asking those interview questions like, how do you handle failure and setbacks? Or maybe, what's the biggest challenge you face in your career? I mean, that's a huge one.
Absolutely. A real-world crucible.
So within that broader insurance segment, there's this other piece, the Kansas Bankers Surety Company, KBS. Sounds like a niche player. Can you tell us a bit more about its journey, its unique position?
Yeah, KBS is fascinating. It was purchased by WesFEI back in 1996 for about $80 million in cash. It contributed a solid $7.4 million to after-tax operating earnings in 2002, though that was down slightly from $9.3 million in 2001. Now, it was chartered way back in 1909, originally to underwrite deposit insurance just for Kansas banks, but it has quietly expanded its customer base, now operates in 27 states, mainly Midwestern states, as the letter says. And beyond those original deposit guarantee bonds, KBS now offers directors and officers indemnity, employment practices policies, and interestingly, even recently ventured into internet banking catastrophe theft insurance.
So it really illustrates how a niche business can adapt over, nearly a century, right, to changing needs. That's a pretty concrete answer to how do you identify market opportunities.
Definitely. And what's also really notable is KBS's combined ratio, which, for listeners, is a key indicator of an insurer's underwriting profitability. Basically, how much an insurer pays out in claims and expenses for every dollar of premium it collects. Anything under 100% is generally good. Well, KBS's was an excellent 71.3% for 2002, and even better, 55.1% in 2001.
Wow, that's significantly better than average, isn't it?
Oh, hugely better. It signals an incredibly disciplined and profitable underwriting operation. Especially impressive given how tough the insurance market was at that time. And, get this, KBS also dramatically reduced the amount of business they ceded that's transferred to reinsurers. Think of reinsurers as insurance for insurance companies. They cut it from almost half down to about 5% since 1998.
So they were taking on more of the risk themselves.
Exactly, signaling increased confidence in their own underwriting. They were basically saying, we'll accept more potential ups and downs in income because we think we'll make more money keeping it ourselves. More potential return directly to Wesco.
Interesting. And who is leading this consistently strong performer?
KBS is described as ably run by Donald Towell, the president, and he was assisted by just 15 dedicated officers and employees.
15? Wow.
Yeah, a really small, focused team, which I think highlights the importance of strong, concentrated leadership, and team building and navigating a specialized industry for such consistent performance.
Okay, let's shift gears a bit, moving to a different kind of challenge. Court Business Services Corporation. This sounds like a pretty significant acquisition for Wesco. They paid $386 million in cash for it in February 2000. And Court is described as the country's leader in rent-to-rent furniture. What happened after that substantial investment?
Well, it wasn't smooth sailing initially. Cort's after-tax operating income, now this is before goodwill amortization, for the full year 2000 was respectable $33.4 million, but then it plummeted down to $13.1 million in 2001, and then just $2.4 million in 2002.
Oof, that's a steep drop.
It is, and the letter is incredibly frank about it. It states, quote, 2002 was a terrible year in the rent-to-rent segment of the furniture rental business. The reasons given, the burst of the dot-com bubble, the events of September 11, and just continued weakness in the economy.
And they actually admitted they were poor predictors of near-term industry-wide prospects. That's incredibly candid for a company in a public letter, isn't it? Most companies would try to, spin that somehow. What does that humility tell us about Munger's leadership style?
I think it tells us a lot. That candor is truly remarkable. It speaks to maybe an integrity of leadership, a willingness to face facts.
So was Court just collapsing under these external factors, or was there evidence they were, fighting back, innovating?
Oh, definitely fighting back. No, Court wasn't just treading water. Despite that terrible market, they were still innovating and expanding. For instance, Court launched a new subsidiary in 2001, Relocation Central Corporation. It developed a virtual call center with an internet-based operation for furniture and apartment leads. Now, this startup, it did generate pre-tax losses initially, but it was clearly a sign of forward thinking, right? Adapting. And Court also acquired its largest competitor in December 2002. That expanded them to 20 metropolitan cities in 16 states. Plus, despite the revenue decline, Court stayed cash flow positive. They invested $57 million in expanding through acquisitions and even managed to reduce their line of credit debt by $30 million.
Okay, so they weren't just sitting there. It really demonstrates a proactive spirit. Speaks directly to those questions like, what role does innovation play in your business, or how do you stay motivated during tough times?
Exactly. The company's belief in its long-term prospects, despite those immediate struggles, that's a powerful lesson in strategic patience, I think. And Munger gives a lot of credit to Paul Arnold, Court's leader at the time. He praises him as a star executive for the progress Court made under his leadership, quote, despite adverse developments.
Makes sense. Okay, finally, let's touch quickly on Precision Steel Warehouse, Inc. It's noted as a smaller piece of the Wesco puzzle, contributing just $0.3 million, ultra 3R hammer, to operating earnings in 2002. What's its story?
Yeah, while it's a smaller piece, Precision Steel Warehouse, they supply high-precision rolled metals for industrial uses. It offers another, maybe starker example of navigating a truly brutal industry downturn. The steel industry itself was described as a disaster in 2000, and 2001, much worse. So Precision Steel saw a significant reduction in demand and intensified competition, quote, above the fierce level encountered in the prior year. That led to a nearly 30% decrease in pounds of products sold and a 25% drop in sales revenues. Pretty tough.
Sounds brutal.
It was. However, Terry Piper, the president and CEO, is specifically credited with doing an excellent job leading the company through these difficult years. So again, it highlights those profound challenges like how do you handle competition, especially when it's that fierce. And it just emphasizes the indispensable role of strong leadership during severe economic downturns.
Okay, so that covers the subsidiaries. But beyond those operational details, the letter also digs into Wesco's overall financial health and, maybe most interestingly, its overarching investment philosophy. Its net worth, for example, actually increased to $1.96 billion, or $275 per share at the end of 2002, despite all those challenges.
Right. And one fascinating detail, Munger mentioned something you probably wouldn't see highlighted this way in many reports, is what he calls Wesco's interest-free loan from the government. He calculated it amounted to about $28 per Wesco share at year-end 2002.
An interest-free loan from the government, how does that work?
It comes from deferred income taxes on unrealized gains from their investments. You see, they hadn't sold the investments, so they hadn't paid the tax yet, but the value was there on the books. It's not just a quirky detail. Munger saw it as a powerful financial advantage. It meant Wesco essentially had free capital afloat to deploy, derived purely from how you account for those unrealized gains. Now, he does clarify it's not a perpetual advantage. Taxes would eventually be due if they sold. But for any financial analyst reading this, it reveals how deeply understanding tax nuances can really shift your perception of a company's true financial strength and, maybe, its strategic flexibility.
That's a really insightful point. The letter also offers this incredibly candid, almost surprisingly humble assessment of Wesco itself, especially when compared to its parent company, Berkshire Hathaway.
Absolutely. It's quite striking. Munger stakes flat out that Wesco's business and human quality is not nearly as good as Berkshire Hathaway's. He explicitly says, quote, "Each dollar of book value at Wesco continues plainly to provide much less intrinsic value than a similar dollar of book value at Berkshire Hathaway." And he adds that this quality disparity had actually continued to widen in favor of Berkshire Hathaway in recent years.
Wow. To say that about your own company in a letter to shareholders.
It's incredibly rare, isn't it? That level of self-awareness and frankness from leadership in a public document. It speaks volumes, I think, about their internal culture. Honesty, maybe?
Yeah, definitely. And that candor, it seems, extends to their broader investment strategy, right? There's a direct quote from Warren Buffett himself in there.
Indeed there is. Buffett's letter to shareholders, quoted by Munger, reveals their deeply cautious stance during this period. Remember, this is 2002, after the dot-com bust. Buffett wrote, "We continue to do little in equities," he states. "Despite 3 years of falling prices, we still find very few that even mildly interest us." And he calls that a dismal fact that's testimony to the insanity of valuations reached during the Great Bubble. And he warns, unfortunately, the hangover may prove to be proportional to the binge.
Strong words. And did they have a specific benchmark?
A very clear one, Buffett stated. Unless, however, we see a very high probability of at least 10% pre-tax returns, we will sit on the sidelines. And Munger notes that this patience and discipline is exemplified by the fact that Wesco found, quote, "no new common stocks for our insurance companies to buy in either 2001 or 2002. Zero."
Just sat on the sidelines with cash then.
Pretty much. It offers profound insight into what's your investment philosophy from two, legendary investors. It really underscores the importance they placed on patience, discipline, and waiting for the right pitch, even when others might be bargain hunting or panicking.
Absolutely. And finally, just a small note at the end of the letter, but significant perhaps.
Yeah.
2 long-standing directors, Jim Gamble and Dave Robinson. They'd seen Wesco stock appreciate about 5,000% during their decades of service. They were not standing for re-election.
Yeah, a small detail, but it reflects things like corporate governance, succession, and just the passing of a legacy, doesn't it? The end of an era for them.
And that truly was a deep dive. Wow. We've seen how seemingly dry letter to shareholders from way back in 2002 can illuminate such profound lessons. Lessons about business resilience, the strategic implications of acquisitions, the really intricate impact of accounting rules, and that enduring philosophy of value investing. All through the lens of very specific challenges and achievements.
It powerfully demonstrates, I think, that the answers to those broad, engaging questions like, how do you handle failure? Or what role does innovation play? They aren't just abstract ideas. They're played out in the very real, often incredibly challenging journeys of companies like Wesco. And it highlights how diligence, a willingness to really dig deep into the primary source material, can provide unique insights that go far beyond the headlines.
Absolutely. So thinking about Wesco's candid self-assessment, comparing itself to Berkshire and that extremely cautious investment stance during that particular period. Here's a provocative thought for you listening. What deeper questions would you ask a company's leadership today? To truly understand its intrinsic value, as Munger puts it, and its preparedness for future challenges, especially when the headlines and those initial numbers maybe only tell part of the story. What does this deep dive really suggest about the power, the hidden power, maybe of thoroughly examining even the most unassuming documents?